It's pretty amazing when you think about it. Warren Buffett, maybe the most famous investor ever, his office could apparently fit in less than half a tennis court.
Right, or that his first real business was just buying Coke bottles for a nickel and selling them for a bit more.
Exactly. These little details, they kind of hint at the simplicity behind his massive success.
It's all about those core principles.
Absolutely. And that's what we're diving into today. Welcome, everyone. We're exploring the mind of Warren Buffett, not just the legendary results, but the timeless ideas driving his decisions.
And we're drawing heavily from Robert Hagstrom's book, The Warren Buffett Way, which is really considered the definitive guide.
It really is. Sold over, 1.2 million copies? And you've got investment legends like Peter Lynch praising it, John Bogle calling Buffett his best teacher. That says a lot.
It really does. Hagstrom focuses on the principles, not just hot stock tips, the core ideas that last.
So, our mission today, we want to unpack Buffett's key investment ideas, figure out the how and why behind his moves, and see how you can maybe use some of this wisdom yourself to become a more informed, more confident investor without getting totally overwhelmed.
Right, because it doesn't have to be overly complicated.
Okay, so let's start at the beginning. His early partnership back in 1956 started with just $105,000.
Peanuts, really, compared to today, but from 7 limited partners.
But here's the kicker. Over 13 years, it grew at nearly 30% a year. Compounded. That absolutely crushed the Dow Jones average.
By 22 points on average. And incredibly, it never had a losing year.
Yeah.
Not once, even when the overall market went down.
That discipline was there right from the start.
Oh, absolutely. Look at the American Express investment in '63. There was this huge scandal, the salad oil scandal, and the stock just tanked. Fell from $65 to $35.
Panic selling, basically.
Total panic. But Buffett looked past the noise. He saw the underlying strength of the Amex brand and business. So what did he do? He put 40% of the partnership's money into it. $13 million.
Wow, 40%. That's incredible conviction.
Huge conviction. And it paid off massively. The stock tripled in 2 years. They made $20 million profit. It just showed his willingness to be bold when he saw real value obscured by fear.
But then, despite all that success, in 1969, he just closed the partnership down. Why?
Yeah, it seems counterintuitive, right? But he felt the market had become too speculative, frothy. He couldn't find businesses selling at prices that made sense according to his principles.
So he just walked away rather than compromise?
Exactly. Principles over profit chasing. Some partners went to the Sequoia Fund, run by Bill Ruane, a friend. And Buffett, well, he turned his focus to a little textile company called Berkshire Hathaway.
Okay, so to really get Buffett, we need to understand his influences, the big thinkers who shaped him, starting with Benjamin Graham.
Right, the dean of financial analysis. His books, Security Analysis and The Intelligent Investor, were foundational for Buffett.
What was Graham's core idea?
It was actually quite simple, but powerful. Yeah. He said, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Anything else, that's speculation.
Safety of principal first. That's a different mindset.
Totally different. Protect your downside before chasing upside. It's all about not losing money. His famous rules, rule number 1, don't lose. Rule number 2, don't forget. Rule number 1.
Simple but effective. And his margin of safety.
That was key. Buying something for significantly less than what you calculate its real or intrinsic value is. Like buying $1 for 50 cents.
How did he find those deals?
He looked for companies trading below, say, 2/3 of their net asset value, basically what you'd get if you sold off everything, or companies with really low price-to-earnings ratios. Often, these were stocks that were just deeply out of favor. Nobody wanted them.
Because the market gets emotional.
Precisely. Graham believed fear and greed constantly made the market misprice things. But eventually, prices tend to revert to the mean, back towards their real value. And that inefficiency is where the rational investor profits. He had his great analogy of Mr. Market, but we can get to that later.
Okay, so Graham was very numbers focused. Then there's Philip Fisher. What did he bring?
Fisher shifted the focus more towards understanding the business itself, the qualitative side. He looked for companies with really strong growth potential.
Like what specifically?
Things like high sales growth, a real commitment to R&D, a great sales team, and of course consistent profits, good margins, cost controls, solid accounting.
And he had that scuttlebutt method, right?
Yeah, scuttlebutt. He believed in doing real detective work, talking to customers, suppliers, even competitors, former employees, anyone who could give you insight beyond the official company line. Digging deep.
That sounds like a lot of work.
It was. But Fisher also believed in concentration. He thought it was better to own just a few outstanding companies you knew inside and out, rather than a whole basket of average ones.
So fewer companies, maybe less than 10.
Often, yeah. With maybe 3 or 4 making up the bulk of his portfolio, it ties into his idea of the circle of competence. Only invest in what you truly deeply understand. If you don't get the business, stay away.
Makes sense. And quickly, John Burr Williams.
Williams developed the dividend discount model, basically a way to calculate intrinsic value by estimating all the future cash, mostly dividends, a company will generate for its owners. A stock's only worth what you could eventually get out of it.
Got it. And finally, Charlie Munger, Buffett's partner, his alter ego.
Munger was hugely influential. He really pushed Buffett more towards Fisher's way of thinking, appreciating the quality of the business, not just the cheapness of the stock.
The cigar butt approach versus buying great companies.
Exactly. Munger famously said, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. He also brought in a deep understanding of psychology, building on Graham's ideas about market emotions to understand why people make irrational decisions. The psychology of misjudgment, he called it.
So Buffett really pulled all these threads together.
He's a synthesis, yeah. He started very Graham-like, quantitative, but he evolved, heavily influenced by Fisher and Munger, to focus on quality businesses with long-term competitive advantages, bought at a reasonable price. Deep value meets business quality.
Which brings us to Berkshire Hathaway itself, this struggling textile mill he took over.
Right, in 1964, it had a net worth of maybe $22 million.
And 40 years later?
$69 billion.
Yeah.
With the B, that's a compounded annual growth in book value per share of over 22%, which is just astonishing.
How did that happen? What was the shift?
Well, a big part was moving beyond just buying stocks. As the market got more expensive, finding those Graham-style bargains in public stocks became harder.
So he started buying whole companies instead.
Increasingly, yes, it allowed him to deploy larger amounts of capital. Plus, frankly, he preferred dealing directly with the managers running the businesses, rather than, as he put it, getting involved in corporate governance fiascos. He liked building relationships.
Okay, so what kind of businesses does he actually buy? Let's break down his tenets. First, simple and understandable.
This is fundamental for him. You have to understand how the business makes money. If you don't get it, you can't possibly predict its future earnings with any confidence.
Makes sense. Like Coca-Cola.
Perfect example. Simple product, fizzy sugar water, basically. But with this incredibly powerful brand and an unbeatable global distribution network, you can understand that. You can see its durability.
And the Washington Post.
Yeah, his family had ties to journalism, so he understood the newspaper business. He knew the economics of a dominant local paper were usually very good, even if the paper itself wasn't top tier, just because it had that local monopoly. It was inside his circle of competence.
Okay, simple and understandable. Second tenet, consistent operating history.
Right. He's not looking for fixer-uppers or turnaround stories. He wants businesses that are already successful, with a long track record of consistent performance, and ideally, still have room to grow.
So no big pivots or radical changes needed.
Exactly. Think Coke again. Selling the same basic drink for over a century, just way, way more of it. Or Gillette dominating razors since the 1920s, always innovating incrementally within that core business.
The shaving quote is classic.
Pleasant to go to bed knowing 2.5 billion males will have to shave in the morning.
Yeah, it just speaks to that predictability he craves. Even Benjamin Moore paints 121 years old, known for quality, strong brand. Consistent.
Predictable, stable. Got it. And the third business tenet, favorable long-term prospects. The moat idea.
Yes, the economic moat. He looks for businesses with a durable competitive advantage, something that protects them from competitors, like a moat around a castle. He often calls these businesses franchises.
What makes a business a franchise in his eyes? It usually has a product or service that's needed or desired, has no close substitute, and isn't heavily regulated, which gives it pricing power. It can raise prices without losing much business, even if overall demand isn't growing.
Can you give an example?
Sure. Think about Justin Brand's cowboy boots. With brands like Nocona and Tony Lama, they dominate that niche. Or Acme Bricks in Texas. You might think bricks are just a commodity.
Yeah, brick is a brick, right?
You'd think. But Acme built such a strong regional brand, partly through clever marketing with Troy Aikman, that they achieved huge market share and brand recognition. They turned a commodity into a franchise with a moat.
That's clever. And Pampered Chef.
Another one. Started small, focused on home cooking tools, sold through in-home parties. Built a strong brand with proprietary products. and faced very little direct competition for a long time. Simple, consistent, with a protective moat.
Okay, so the business has to be right, but then there's the people running it. Management tenets. What does he look for there?
This is absolutely crucial for Buffett. He talks about wanting managers with admirable qualities. He famously said, "We've never succeeded in making a good deal with a bad person."
Integrity first.
Always. He looks for three things: integrity, intelligence, and energy. And he adds, if you don't have the first, the other two will kill you.
That's a powerful line. What's the most important job of a manager, in his view?
Rational capital allocation, deciding how to use the company's profits, reinvest in the business, make acquisitions, pay dividends, buy back stock. He thinks this is the most important decision management makes, and most managers, frankly, aren't great at it.
Why is it so important?
Because how capital is allocated determines the long-term value creation for shareholders. Good decisions compound wealth. Bad decisions destroy it. Look at Fruit of the Loom. He bought it out of bankruptcy. Why? Strong brand, sure. But critically, the former CEO, John Holland, who was highly respected, agreed to come back. Buffett insisted on it. Management mattered.
He also paid a premium for Shaw Industries, the carpet maker, right, because of the managers.
Exactly. Julian Saul and Bob Shaw were exceptional operators. Buffett trusted them implicitly, and they even kept a stake in the company, aligning their interests.
And Katharine Graham at the Washington Post.
A prime example of smart capital allocation. She decided to buy back huge amounts of the Post's stock, 43% of the company when it was cheap, between 1975 and 1991. That created enormous value for the remaining shareholders. Textbook rational decision-making.
Another big one for him is candor, honesty.
Oh, absolutely. Managers need to report results fully and honestly, admit mistakes. Buffett himself is known for this in his Berkshire letters. He openly admitted he was dead wrong about the risks at General Reinsurance after the merger, especially post 9/11.
Why is admitting mistakes so important?
He believes, and Munger really drilled this into him, that you learn far more from mistakes than successes. And he also says the CEO who misleads others in public may eventually mislead himself in private. Candor keeps you grounded in reality.
Interesting. And avoiding the institutional imperative, what's that?
It's the tendency for companies to just mindlessly imitate what their peers are doing, even if it's value-destroying. Expanding just to keep up, making dumb acquisitions because everyone else is, that kind of thing. Resisting that herd behavior is key.
Like Clayton Homes, the manufactured housing company.
Perfect example. That whole industry got into trouble making risky loans and overexpanding. But Clayton had this unique compensation model where salespeople shared in the losses if loans went bad. It incentivized prudence. Their default rates were half the industry average. They resisted the imperative to just chase volume. Buffett saw that rational culture liked the management and bought the company.
Okay, so business management, now the financials. What numbers does he focus on?
He looks at averages over, say, 4 or 5 years, not just a single-year snapshot. And a key metric is return on equity, or ROE. He thinks it's the best single measure of how well management is performing economically for the owners.
So how much profit the company generates relative to the shareholder stake?
Exactly. Think Coca-Cola again. Under CEO Guzaweda, ROE went from around 20% up to over 30% by 1988. How? By selling off lower return businesses and pouring money back into the high return core syrup business. Smart capital allocation boosting ROE.
And the Washington Post, too.
Same story. ROE doubled within 5 years after Buffett invested, hitting over 36%, while they also paid down debt. Strong management driving strong returns.
He also talks about owner earnings, right? What is that exactly?
Yeah, this is his preferred measure of profitability. It's basically net income plus non-cash charges like depreciation minus the estimated amount of capital expenditures needed to maintain the company's competitive position and unit volume. It's trying to figure out the cash that's truly available to the owners after keeping the business healthy.
So it's a more realistic measure of cash flow than just net income.
He thinks so. He also looks for high profit margins, pre-tax margins especially. That suggests the company has pricing power or is very efficient.
And the $1 premise?
Ah, yes. It's a quick test. For every dollar of earnings the company retains, doesn't pay out as dividends, does it create at least $1 of additional market value for the company over time? It checks if management is reinvesting profits effectively.
Okay, so you found a simple, consistent business with a moat, run by honest, rational managers, and the numbers look good. When do you buy? The value tenets.
This brings it all together. You first have to estimate the intrinsic value of the business, what it's truly worth. Then you only buy when the market price is significantly below that value. That's the margin of safety Graham talked about.
How does he calculate intrinsic value?
Primarily using a version of that dividend discount model from John Burr Williams, discounting future owner earnings back to the present. But critically, he doesn't really add a separate risk premium like academics do. His safety comes from focusing on predictable businesses he understands well and demanding that big discount up front.
So give me an example. Coca-Cola in 1988.
Right. The market valued Coke at about $15 billion. Buffett's calculations, depending on his growth assumptions, put its intrinsic value somewhere between $20 billion and maybe $48 billion.
Whoa, so he was buying it at maybe a 30% to 70% discount.
Exactly. A huge margin of safety, even for a giant, stable company like Coke.
And Wells Fargo in 1990, the market was scared then.
Terrified about California real estate loans. The stock was hammered. Buffett bought in at around $58 a share, spending $3 billion total. His analysis suggested the bank was actually worth closer to $6.6 billion, a 55% discount. He did his homework, decided the risks were manageable, and acted decisively while others panicked.
Even smaller deals, like Larson Jewell, the picture frame company.
Yep, it was in a temporary slump. He bought it for $223 million. His quick analysis, using a reasonable discount rate and modest growth, suggested it was worth closer to $440 million. Huge discount. And the deal was done, handshake and all, in just 12 days.
Incredible speed when he sees value.
It comes back to his mantra. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. Be ready, be rational, and act.
Now, this disciplined thinking isn't just for stocks, is it? He applies it to fixed income, too. Bonds, cash.
Absolutely. Typically 20–30% of Berkshire's portfolio is in fixed income stuff. Sometimes it's because stocks look too expensive, or sometimes it's just the nature of the insurance business needing lots of safe, liquid assets.
But he approaches bonds differently than most, right?
He does. He uses the same core principles. He thinks of buying a bond as buying a piece of a business. He looks at the quality of the underlying company, the management, the long-term prospects, just like with stocks.
So that WPPSS municipal bond situation in the 80s.
Classic Buffett. Washington Public Power Supply System, some of their nuclear projects defaulted, caused chaos in the muni market. Bonds for the other, safer projects, 1, 2, and 3, got dragged down too, trading at like 40 to 80 cents on the dollar.
So he jumped in.
He bought aggressively. He saw it not just as a bond yielding 15–17% tax-free, but as buying a solid, unleveraged business, the power projects, earning a great return at a massive discount to its actual value. Business thinking applied to bonds.
Even junk bonds. RJR Nabisco.
Yeah, 1989–90, the junk bond market collapsed. He bought RJR bonds, arguing the company's stable products, cookies, crackers, tobacco, generated plenty of cash to cover the debt. He felt it was unjustly punished by market fear. His quote was great. Yesterday's weeds are being priced as today's flowers, spotting value where others saw only risk.
He did this again in the 2002 telecom bust.
He did. Bought bonds of struggling companies like Level 3 and Quest. Again, assessed the assets, the management, the path forward. Doubled his money on Level 3 pretty quickly. Even bought Amazon bonds back then, praising Bezos for accounting integrity, like expensing stock options. He looks for quality management, even in bond issuers.
And convertible preferred stocks, those hybrid things.
Right. They offer some downside protection with the fixed income component, but upside potential if the company does well, and you can convert to common stock. His big investment in Mid-American Energy involved these, allowing him to invest in the troubled utility sector, but with some safety buffers, alongside management he trusted.
Okay, so he's flexible in what he buys. How does he manage the overall portfolio? It's not about owning hundreds of stocks.
No, definitely not. His approach is called focus investing. It's actually quite simple, though hard to do emotionally.
What are the rules?
Basically, 1, concentrate your money in a relatively small number of outstanding companies you understand really well, maybe 10 to 20. 2, put most of your money into your very best ideas. 3, think long-term, 5, 10 years or more. And 4, when the market gets volatile, which it will, just ignore it. Carry on, as he says.
That flies in the face of modern portfolio theory, doesn't it? All that talk about diversification being the only free lunch.
It really does. MPT emphasizes spreading risk widely. Efficient market theory says prices reflect all information instantly, so you can't beat the market. Buffett and Munger completely reject that. They're bump ignorers. They focus on the business value, not the stock price wiggles.
Has this concentrated approach worked for others?
Definitely. Look at the investors Buffett highlighted in his Super Investors of Graham and Doddsville article, people like Bill Ruane, Lou Simpson, they ran concentrated, low-turnover portfolios and generated fantastic long-term results, even if they sometimes lagged the market in the short term.
And low turnover has other benefits too, right?
Huge benefits. One, you save a ton on transaction costs, brokerage fees, bid-ask spreads. Two, and this is massive, you defer capital gains taxes. Those unrealized gains keep compounding tax-free within your portfolio. Buffett calls it an interest-free loan from the Treasury. The longer you hold, the more powerful that compounding becomes.
Okay, underlying all of this seems to be psychology, controlling your emotions.
It's arguably the most important part. Buffett and Munger understand deeply that investing isn't just an intellectual game, it's an emotional one. Fear and greed are the enemies of the rational investor. They cause people to buy high in euphoria and sell low in panic.
That's where Mr. Market comes in, Graham's idea.
Exactly. Graham imagined the market as this manic, depressive business partner, Mr. Market. Every day he shows up and offers to buy your share of the business or sell you his. Some days he's wildly optimistic and names a ridiculously high price. Other days, he's deeply depressed and offers a crazy low price.
So the lesson is?
You don't have to trade with him. You can ignore him completely unless his price is advantageous to you. Use his emotional swings to your benefit, buy when he's depressed, offering low prices, maybe consider selling if he's euphoric, offering high prices. But never let his mood dictate your actions or your view of the business's value.
Munger took this psychological aspect even further, right? Identifying specific biases.
Yeah. Munger's fascinated by cognitive biases, the systematic ways our brains trick us, like overconfidence. Most people think they're better than average drivers or investors. That leads to making poor judgments, trading too much,
What else?
myopia, or nearsightedness. We tend to focus too much on short-term results. Studies show investors who get frequent performance updates actually end up allocating less to stocks long-term, probably because the short-term volatility scares them. Munger's advice: maybe don't check your portfolio constantly.
Easier said than done. Any others?
Mental accounting. Treating different pots of money differently. Like you might gamble with found money from a bonus, but be super conservative with your retirement savings, even though money is fungible. These biases affect our financial decisions constantly.
And it all ties into risk tolerance, which isn't fixed.
Exactly. Risk tolerance feels very personal, but it's highly emotional and situational. People feel much less tolerant of risk after the market has crashed, even though that's often when the opportunities are greatest. Understanding these psychological traps is key, both to avoid them yourself and potentially to recognize when others' irrationality is creating an opportunity for you.
So wrapping this all up, Buffett's incredible, enduring success isn't magic. It comes from being maybe what George Bernard Shaw called the unreasonable man. Not just adapting to the world, but sticking steadfastly to timeless principles.
Right. Focusing on businesses you can understand that have a consistent history and a strong competitive advantage, run by managers you trust who allocate capital rationally.
And crucially, buying them only when they're available at a significant discount to their real value, and then holding on for the long haul, tuning out the noise.
It really boils down investing to its essentials. He says you need to know accounting, the language of business. You should probably read Graham's Intelligent Investor. But beyond that, it's mostly about cultivating the right temperament: patience, discipline, emotional control.
So here's something to think about as we finish. If Warren Buffett, arguably the best ever, focuses on learning from mistakes and actually welcomes market downturns as chances to buy great companies cheaper, what does that say about how you react to volatility or scary financial headlines? Are your financial decisions driven more by those sound long-term principles, or maybe sometimes more by emotion?